Australia has been recognised as being the lucky country for some time now. And every Australian has reason for thinking that way. In 2007, 2008, the GFC, we pretty much skirted around the debacle again and didn't feel the full brunt of the housing and stock market collapse, as did the United States. This could be, I believe, our Achilles heel. A little like, she'll be okay, mate. Could you give us your impressions as to why on this occasion, with a repeat of the GFC, we may not be so lucky?
Well, I mean, truly, Australia is a lucky country. People say that after skirting through, not quite skirting through, but doing relatively well during the global financial crisis. But I heard that expression in 1982 during my first visit here, so I think that's been around a long time, and with good reason. Of course, Australia has gone 26 years without a recession. I think it's the longest period without a recession of any major developed economy in the world. So that's something to be proud of. Having said that, no one's immune from the laws of economics. It's kind of like the law of gravity. If you jump off a ledge, you're going to have some difficulty. And I think that Australia's success in getting through 2007, 2008 okay may point to some difficulty in the future. I'm thinking specifically of China. Now here I'll go all the way back to 1998. 1998, we had another global financial crisis, not as bad as the one in 2007, 2008, but pretty bad. And it started in Asia. It started in Thailand, pretty quickly spread to Malaysia, Indonesia, South Korea, ultimately Russia, then over to a hedge fund in the United States, Long-Term Capital Management, where I actually negotiated that bailout of that hedge fund with the sponsored by the U.S. government. There was no taxpayer money involved. It was all Wall Street money, but the Federal Reserve Bank, our central bank, certainly brought the heads of the Wall Street firm together to solve that. Now, my point is that was a lesson to Asia. They had a currency crisis and a reserve crisis. So in the years that followed, they pursued a policy called precautionary reserves, meaning they said, we never want to be in that position again, where our hard currency is drained from us, and we're defaulting on our debts, and we have to close the capital account. So they built up these precautionary reserves, and one of the leaders in that was China. What that meant was that when the global financial crisis hit, China was in a position to respond very forcefully. They had fiscal stimulus, basically it wasn't a deficit, but they had the capacity to use government spending to get them out of the crisis, even to a greater extent than the United States. The United States had a $850 billion stimulus bill that was passed in February 2009, March 2009, to give the U.S. economy a boost. Didn't do much. China's stimulus was even bigger. Now, of course, when China was taking the money and using the government stimulus, where were they buying their goods? They were buying them in Australia. Copper, coal, iron ore, a lot of other resources as well, agricultural exports and so forth. So in some ways, Australia benefited from China's prudence going all the way back to the 1998 crisis of being prepared for 2008. So that was good for Australia. The problem now is that you're very dependent on Australia, and that's good as long as everything's fine. Sorry, you're very dependent on China, and that's fine as long as everything's good there. But China has gone on a debt binge and a borrowing binge, kind of the opposite, whereas prior to 2008, they were preparing by building up savings. Since then, they've relied on debt. So the next crisis in China, actually the next global financial crisis, might actually begin in China because of the debt, because of the excessive leverage. And if that happens, then Australia, far from dodging the bullet, may be right in the crosshairs. Right. So I'm not saying it will play out exactly that way, but there is some reason to think that Australia will have a more difficult ride in the next crisis because of its reliance on China.
Makes enormous sense. Recognising Australia's position in the upcoming economic storm, how would you suggest Australians brace themselves in preparation, and what would you suggest as an investment strategy?
Well, my advice for Australians, for the government, I did speak to the Deputy Finance Minister at one point, the Deputy of the Central Bank, but my advice for Australians is no different than my advice for Americans or Canadians or individuals or institutions anywhere in the world. You need to have some allocation to gold. Now, I recommend physical gold, not paper gold, not gold futures, gold ETFs, etc. My recommended allocation is 10%. Some people want to put words in your mouth. They say, Jim Rickards says, sell everything and buy gold. I've never said that. I predict financial crises, you can see those coming, but it's not the end of the world. You know, it's not the apocalypse we muddle through, but you'll get through it a lot better with a 10% allocation of gold. Now, you can kind of season to taste. I have clients who have as much as 50%. I said, well, you didn't get that from me, but that's their preference.
Right.
But when you look at institutional investors, globally, they have about 1.5% in gold, and that's not evenly distributed. What you find is that some may have 4 or 5%, and most have zero. It averages out to about 1.5%. But even if they went to as little as 5%, there's not enough gold in the world at these prices to meet that demand. So for the individual, I recommend 10%. I would say the same for institutions, but even 5% would serve you well. Beyond that, I think I have a large allocation of cash. People say, well, gee, Jim, you're the guy talking about the death of money and the collapse of the dollar. Why would you have cash? My answer is I might not want it forever, but at least for now, it obviously adds liquidity, but a cash component in a portfolio reduces the overall volatility of the portfolio. So if stocks and bonds and gold and things like that are bouncing around, cash doesn't do anything. So that reduces the total volatility, so you can sleep a little bit better at night. But it has huge embedded optionality. If you have a crisis and there's a fire sale and prices are collapsing, you're the one who can go out with the cash and pick up some bargains. And nobody's better at that than our friend Warren Buffett. And it's just to kind of expand that point, today, Warren Buffett's Berkshire Hathaway, that's his holding company, has $100 billion in cash. Now, why does Warren Buffett have $100 billion if he doesn't see what I'm seeing, which is, and he's very well known for when these collapses come, as they periodically do, to kind of go out and get some bargains. So 10% gold, maybe 20 or 30% cash. I like real estate. I like fine art. That's a hard category to invest in. We're not talking about the kind of posters you put in your college dorm room, but museum quality art. But if you can have access to that either directly or through a fund, that's good. I own some stocks, but they tend to be private equity. Some fintech startups, natural resource startups. So you don't have to be all in the listed stock markets to get very good gains. And the listed stock markets, of course, are the most vulnerable in a panic.